Hello and welcome. This is Kathleen Movito, and I'll be your host for today's webinar entitled Finding the Best Deal, Comparing Mortgage Rates versus Fees. Joining me today is Kevin Crooks, Mortgage Loan Officer for AAFMAA Mortgage Services, and he will be sharing just about 20 minutes of slides for you today. If you have any questions during the presentation, please enter them into the question block on your screen. This monthly webinar series is brought to you by AAFMAA Mortgage Services LLC. We are a wholly owned subsidiary of AAFMAA, offering a full spectrum of mortgage products to the military community. Currently, we conduct business in Alabama, Colorado, Connecticut, Delaware, Florida, Indiana, Iowa, Kansas, Kentucky, Maryland, North Carolina, Oklahoma, Oregon, Pennsylvania, Rhode Island, Tennessee, and Virginia. And we will continue to open offices in states across the country. The AAFMAA Mortgage Services team consists of state licensed loan officers. Among all of our professionals, we have decades of both military and industry experience. We are an equal housing opportunity lender, and for your record, our NMLS is 1423968. As a wholly owned subsidiary of AAFMAA, we operate with the same values and priorities of our parent company. AAFMAA stands for American Armed Forces Mutual Aid Association and is the longest-standing not-for-profit association that empowers military families with affordable financial solutions. We accomplish this by being the premier provider of financial planning, investment management, and trust services for the military, not-for-profit. This presentation is educational. It's for general information only and is not specific investment, legal, or tax advice for any of you individually. Do not rely on this presentation alone to guide your home purchase decisions. Since each individual situation is unique, the type of loan that benefits you the most will not necessarily be the same as another current or former service member. For individual advice, please contact us directly. We produce this webinar series in-house with our own professional staff as a service to our members and help them better understand the resources that are available to them. I will now go ahead and turn it over to Kevin, who will go over the agenda.
Thanks, Kathleen. As you mentioned, my name is Kevin Crooks. I'm a loan officer here with AAFMAA Mortgage Services. I work in our typically sunny Wilmington, North Carolina location. And today we're just going to help go through a few things to help you shop and to make sure you get the best mortgage. Because that is 100% our mission here at AAFMAA Mortgage Services, is to make sure that the mortgage that you're getting is the best mortgage to fit your needs. And, the vast majority of the time that is going to be through us. But if for some reason, due to your situation, if a competitor is able to offer you a better deal, we would also be happy to help you analyze and give you a fair, unbiased opinion to determine what is the best mortgage. But my goal here today, though, is to make sure that you don't get tricked into thinking one mortgage is better than the other by the way it's disclosed and gone over. So namely, what we're going to go over today is helping you shop mortgages and compare lender fees, and then also shop rates by comparing discount points. So we're going to go through that. We're going to do a couple of examples that helps you determine the best rate, and then we'll wrap everything up and answer some questions. So first, we'd want to go over what are lender fees and discount points. The thing is, unfortunately, with a mortgage, it's not as easy as just looking at the rate or looking at the bottom line and closing costs to determine which is the better deal. One of the main shopping tools that you'll want to get when comparing mortgages and mortgage companies is an estimate of their closing costs. Some lenders call this a closing cost worksheet, a closing cost estimate, a loan itemization. The official version is called the loan estimate, which you'll usually get at application. But while shopping, you get the lender's version of that form. But essentially, what it is it's an itemized list of both the closing cost, the rate, and the payment. The thing with that list is the vast majority, all but 2 or 3 line items, are what we call third-party fees. That's going to be your attorney fees, your closing fees, your title insurance fees, any taxes that your state may charge, your property taxes, insurance, all of those items, which, probably make up 80%, 90% of your total closing costs, are going to be exactly the same or more or less, within pennies, regardless of which lender you choose. And the reason being is because, as I mentioned, those are third-party fees. Those fees are dictated by the vendor or organization chosen. As a lender, our job is just to disclose those fees to you because they are a part of your transaction. Where that can get a little bit muddy is because they are estimates. It depends on how accurate your lender's estimates are. Here at AAFMAA, we try to, estimate those fees, not only accurate, but because we're not in control of them, we'll try to overshoot and estimate things just slightly on the higher side of a range. So, as to prevent you from being surprised at closing. Our goal is to estimate one figure, and then hopefully by closing, you should actually be bringing a little less money to the table. Unfortunately, some lenders, they may choose to operate their business, in a different fashion, and they may, underestimate those fees slightly. So if you just looked at the bottom line, a lender that underestimated their fees, their closing costs are going to look less, but really all they've done is underestimated fees that they're not in control of. So that's certainly important to look at. And then also, what you want to look at and what we're going to really dig into today is the lender fees. Lender fees are, fees on your loan estimate that 100% of that fee goes to the lender. It's not to pay for a service provided by another entity. And, thankfully, due to some of the new regulations through the CFPB and the TRID law, they've kind of homogenized how lenders have to disclose these fees. And nowadays, we can only call lender fees can only be called a handful of items. Where in the past, they might have called to muddy the waters. They could have called a commitment fee 6 different things. So it was really hard to discern between lenders which were their actual lender fees and which weren't. This isn't an exhaustive list, but the most common lender fees are going to be the first 2, what we call origination fees, and those can be a flat origination fee, or some folks still charge a percentage of your loan amount for origination fee, and commitment fees. Those are the two big ones that most lenders will charge or some form. But you can also be, you also need to look through the loan estimate, because sometimes some folks still are allowed to still charge underwriting fees, tax service fees, or processing fees. So that's something to look at, is because not only can lenders they may split their lender fee up and call it several different names. And when you add it together in aggregate, it may be more expensive than somebody who just has a flat origination charge. So those are fees that will go directly to the lender. Those are the ones that the lender are in control of, and those are the ones you really want to zero in on when comparing loan estimates. The other fee, which isn't necessarily a lender fee, I mean, it's a discount point. That fee is essentially prepaid interest. It's money that you pay to what they call buy a rate down or get a lower rate. So when you're comparing mortgages or loan estimates between lenders, you're going to want to look at the rate, but not only the rate, you're going to want to look at the lender fees and the discount points. I mean, the most common question I usually get when somebody, calls and wants to inquire about a mortgage is what your rate. And I mean, that is 100%, that is important. But, other lenders, they know that that's important, and they know that folks go in on that rate. And what they may not be as forthcoming with is all the fees that are attached to that rate. And that's what we're going to walk through here now and kind of show you how that works and show you the differences. So we've got a couple examples here, and I just tried to use round numbers, to make things easier. And say, you call, in this example, the loan amount is going to be $200,000, and we've got a 30-year mortgage. So you call the first lender and you ask them, what their mortgage rate is, and you'd like to see an itemization of their closing costs. So in that, when they provide that itemization, you notice that they have a $1,200 origination charge, and then they're also charging you 1% discount points. And 1% of $200,000 is $2,000. So, what you notice, that the non-third-party fees on that loan estimate are a $1,200 origination, a $2,000 discount point, for a total of $3,200. So we have $3,200 in lender fees, and then we've got a $200,000 mortgage at 4.25% for a 30-year rate, or 30-year mortgage. That gives you a principal and interest payment of $984. So to sum that up, you've got $3,200 in fees, and you've got a $984 payment. Now, we're going to use that same loan amount, as any shopping for anything, you should get more than an opinion, especially, something as crucial as buying a home. So here, you've called the second lender. They have same loan amount, same 30-year fixed, but their rate's 4.5%. I mean, if all you're looking at is rate, then you're automatically going to think that first lender has a better deal. If we dig a little deeper and, we get that itemization of fees, that we notice that their commitment fee is only $875, and they're charging 0 discount points. So their lender fees instead of being $3,200 are only $875. But the rate being 4.5%, that payment is, instead of like $983, I believe, it's $1,013. So in this one, you've only got $875 in fees, but you've got $1,013 in payment. So how do we compare those two? What we want to look at is, is the break even. Well, there's two things you want to look at, but the first and foremost is the break even. And that's basically how long it takes you in monthly savings to just pay back what the fees that you have to pay up front. So if we look at this, lender one is charging $2,325 more in fees. That's because they had the $3,200 in fees, while the second lender was only charging $875. So to kind of break that out in an apples to apples comparison, the first lender is charging $2,325 more in fees, but because they were offering that 4.25 rate, your payment is $29 a month lower. So it's really easy. How you calculate break even is you just divide that extra cost by the savings. So in this example, we have, the $2,325 in fees divided by saving $29 a month, that equals 80 months. So basically the conclusion would be it would take you 80 months or 6.5 years of saving $29 a month just to equal the upfront costs. So certainly for guys that are active duty, or, you may be in a situation where you don't plan on being in the house that long, in no way, shape, or form is taking the lower rate a better deal for you if you plan on owning the home, less than 7 years. And you may want to think, well, I'm buying a home, I plan on owning it for 10 years. And, and so if you just looked at the break even, if you were to own that home, for 10 years, then yeah, the lower rate may be worth it. But you also have to ask yourself, if you do that math, would you rather pay $2,300 and $25 more in fees today to save an additional, the additional savings over 10 years would only be $1,160? Because there's definitely some value in cash and having money on hand. And that's one of those things that depends on your situation. Are you employed? Are you going to be making good money soon? Are you retiring and going to be making less money? But for a lot of people, paying even though they may own the home 10 years, paying $2,300 more in fees now isn't worth it to them to save, just over $1,100 over 10 years. So that's really what you want to look at when you're comparing these different lenders is not only the rates but the fees, because more often than not, paying additional fees to lower your rate, it most likely is not in your best interest or going to be to your advantage. The other thing we want to do, and this is something we help our clients do, is compare different rates with the same lender. Because when you're buying a mortgage, you have several options with your rate. And so say you've zeroed in on the lender that overall has the best deal, but you may want to dig in and see what different kind of rate structures are they able to offer. So it works the exact same way. Or even if you have two lenders, say their rate and lender fees are exactly the same, but their discount points are different. This can help you determine what's going to be a better deal. So let's, in this example, say we have scenario one. We have a loan at 4 3/4 that costs 1% discount, or it's still that same $2,000. So on that $200,000 at 4 1/4, you have a payment of $1,043. And then you're like, well, I don't know if I have $2,000 to spend right now. What would it be if I don't pay that discount point? So in that scenario, typically, and it depends on pricing, but typically 1% of the loan amount changes your rate 0.25%. That's not always the case. It does fluctuate with rate movements, but that's the general kind of price on how that works. So in this example, if you didn't want to pay the $2,000 or the 1% in fees, you would have a $200,000 mortgage. The rate is 5%, but you have 0 discount points. So in that example, the payment is a little more, $31, I think, at $1,074. So here, the break even, the difference is $31. So if you paid $2,000 up front, but saved $31 a month, here it would take you 5 years of saving $31 a month, a little over 5 years, 5 1/4 years, I guess, or whatever. It would take you a little over 5 years just to pay back what you pay up front. So certainly, again, if you plan on owning the home, less than 5 years, in no way is the lower rate your best interest. And then, of course, if you plan on owning the home over 5 years, it still may not be worth it to you to spend that additional $2,000 out of your pocket, knowing that you may only save another $1,000 over the next 10 years. That's just a discussion that you need to have with your loan officer for them to help you determine the best deal. One of the rules that passed with the new banking regulations is we as loan officers cannot get compensated by basically upselling your rate. So that works in your benefit in that the lender, me as a loan officer, and AAFMAA is of course different, but even any other lender, they're going to basically sell you the rate that they have. You don't have to worry about them trying to sell you a higher rate than their lender allows to pad their pocket. That's no longer allowed. So, all lenders should basically be able to, or should be offering, their kind of standardized rate. So if you call two loan officers within the same company, you should have the same pricing. Where in years past, that may not be the case. So, that's just when you're comparing these fees, not only between lenders, but, within the lender themselves and your discount points, that's a conversation that you want to have with them to make sure that you're getting a deal from both the closing cost and payment perspective that fits your overall scenario in, what your 3, 5, 10-year plan is for this home. Conversely, you can sometimes use these rates to your advantage. You can take the exact opposite, and I did include a slide for this, I apologize, but you can do the exact opposite of a discount point. And a lender, we as a lender can actually provide you a lender credit to help offset some of your other closing costs. So again, you know, in a situation, I've seen it depending on how rates are for a given day. You know, we may be able to pay, you know, $2,000 in your closing costs, and it, you know, may only increase somebody's payment $25. You know, in that kind of situation, even if you had the $2,000, you know, burning a hole in your pocket, it still may be worth us as a lender to pay that fee for you, because if you got $2,000 up front and your payment's only $25 more, you know, again, it would take you 80 months just to break even, which, you know, I think is 6.5 years. So, you know, that's the big thing that kind of muddies the waters when shopping for a mortgage. I mean, it has gotten easier, but, you know, lenders know that we're kind of conditioned to shop for rate, and what we may not be aware of is the fees associated with that rate. I think that's where we kind of get to this summary is, you know, as I mentioned, you know, as consumers, and it's without a doubt the single biggest question I get is, what's your rate? And that's where we begin the conversation that, yes, rate is absolutely important, but what we don't want is to make sure that they're not getting exploited by another lender that's advertising a lower rate while charging considerably higher upfront fees. You know, this is very common when you're shopping for rates online. You know, if you look at a lot of the, you know, military-affiliated organizations and credit unions, you know, they advertise very low rates, but if you look at the fine print and read the disclosures, you'll see that they most often come with origination fees and discount points. So, you know, it's up to you as a consumer, and hopefully the help with an honest loan officer, that they would help you, you know, to look at those, to look at the rates and fees, and then determine the best deal for you. I mean, I can tell you from AAFMAA perspective, we have, you know, incredibly competitive rates. I've been hard pressed to find anybody that, you know, is able to offer a better deal than we can. But if that's the case, if you do have another mortgage lender that's offering you a better deal than we're able to offer, then without a doubt, that's a fantastic deal, and we would want you to take that. And we would help you examine those closing cost worksheets between lenders to determine what's going to be the best fit for you. Like I say here, it says that at Mortgages, you know, we're happy to provide an honest and fair comparison of your mortgage options. You know, our mission is to ensure that you obtain the best mortgage, possibly even if that means doing business elsewhere. I think that's all we have. Do we have any questions?
Yeah, we do. All right. So the first question that came in is, do you see the majority of people paying discount points?
No. I mean, truthfully, I've been a loan officer for almost 15 years now, and I'd probably be able to count on two hands the number of clients that I've had that have, you know, chosen discount points. Now, I do worked a lot in the military markets in Jacksonville, North Carolina, so it's a lot of young home buyers. They may not have, you know, those funds available, so it's not even an option. But even those that are retired that have substantial savings typically don't opt for a discount point because there's better uses of their money than to save, you know, $30 or $40 a month on their mortgage. Great,
thank you. All right, next one is, do you have any advice on when to lock in your rate?
Yeah, that is a good question, and the best time to lock, and that depends on an individual kind of substance and what's going on at this particular time in the market. But truthfully, I mean, if you've shopped lenders and you found a lender, hopefully which should be us, but if you found a lender that's giving you the best rate and you're happy with the rate and payment, even the way the market's been, especially the last year, you're going to want to go ahead and lock in as soon as you can and as soon as you have that contract. I mean, overall, the general trend of rates that they're still predicted to go up. We would say the risk is to the upside as far as rates go. And, typically once you find a house, you may only have 30 or 60 days to close. So, rates aren't going to move a whole lot in 30 or 60 days, but the chances are, especially given the market where they're at now, there's more opportunity or more likelihood that the rates would increase as opposed to decrease. So it's kind of one of those things, a bird in hand is worth two in the bush. And, you'd always, even if, after you locked in, if rates went down and ate slightly, I mean, that's way better than the worst that, they could go up an eighth or a quarter. So, in this rate environment, we recommend that, locking in sooner rather than later because, as mentioned, the risk is to the upside.
Great. All right, one more. Are lender fees and discount points tax deductible?
Man, you guys got some good ones. Yeah, that's a good question too. And the truthful answer is I don't know. And I should preface this by saying I'm not a qualified tax individual. I mean, I can tell you in the past, discount points and origination fees were both fully tax deductible in the year that they were incurred. I know that from personal experience. But as we all know, as 2018, there's new tax laws in effect. And they've eliminated a lot of those itemized deductions that we can take. So certainly, if that would be something that you'd want to, especially if that factors in your decision of whether you wanted to pay a discount point, knowing that it's tax deductible, that's something you'd want to ask your tax advisor. But I can say in the past they have been for the new tax laws. I'm not sure. Anything else?
That's all we have time for today. So for anyone with remaining questions, we'll get back to you in just 24 hours probably. So we're going to go ahead and break here for now. If you have any more questions that haven't been answered, or that if you think of questions later, please reach out to us at mortgage@afma.com, and we'll be happy to answer those for you. We do this every day for our military community, and it is our pleasure. This weekend, you'll receive a follow-up email with instructions on how to access a recording of this presentation. You can always register for future webinars and review past webinars at afma.com/webinars. If you found this information useful, we encourage you to please share it with your friends and family. Our membership grows stronger every year because you introduce those in your military community to AAFMAA. Thank you again to everyone listening and for joining us today. We look forward to our next opportunity to assist you.